Good morning and welcome to the SAGA PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Ewan Sutherland, CEO. Good morning, sir.
Good morning and thank you everybody for joining us today. We have a slightly shorter version of the presentation that we gave yesterday in the city. The aim of this morning is to take you through that overview and then allow plenty of time for your questions. We will try and answer every question that comes to us. If we do run out of time, clearly we're very happy to take questions out of the meeting and afterwards. So let me just move you on to the overview of the first half and our forecast for full year earnings. The first half came in ahead of analyst expectations, with underlying PBT broadly in line with the prior year when we've taken it on an IFRS 4 basis. We're obviously transferring across to IFRS 17 as the regulation gets implemented this year. At headline level, the full year earnings are expected to be significantly ahead of market estimates by the end of the year, with a strong double-digit revenue and profit growth. That is driven by a combination of cruise, travel and money. Strong performances from ocean cruise, underlying profit before tax, cash flow, load factor, per diems and customer net promoter score all significantly ahead of the prior year and looking very positive as we go into FY 24 and 25, and I'll cover more of that detail later. River cruise now mirroring ocean cruise, so we're very confident that we've got the proposition right too. And in travel, again, we are seeing strong growth in both customer numbers, revenue and profitability this year, with a good outlook into next year. SAGA Money has had lots of innovation work in the first half and has just launched 2 new products in September, with 2 further new products to be launched in October and more to come in November and into 2025, 4 and 5. In insurance broking, still a significant part of our business. If you look at the home, travel and PMI products, we have all seen strong growth. However, motor is weighing on our earnings, which has led to a £68 million impairment, reflecting the latest projections as we look forward in that marketplace. Quick update on the sale of the insurance underwriter. We did secure a deal, but we have paused that for now. We believe that there's more value to be had when looking at the impact of that sale and the impact on the broker as we move into 2024. So there is a deal there. It's effectively on ice, and we have enough available cash to be able to repay our 2024 bond when it falls due in May next year. Net debt reduced in the half to 657 million, down 54 million, which was lower than January 2023, and we had available cash of 180 million. So just to reiterate, this is a profit upgrade for the year, as we are forecasting full year PBT well ahead of current estimates. Moving on to a little bit more detail in our core businesses, and I'll come back and give you an up-to-date set of numbers after James has run through the financials, but just the headlines here across cruise, travel, money and insurance. Cruise, as we said, very strong performance in the half, 83% load factor, up from 66% the same half last year. Per diems again moving forward significantly, up from £318 to £333 for the half. River cruise back in profitability, mirroring the load factors and per diem numbers that we've seen in ocean. And again, the net promoter score growing significantly in rivers. Travel, again, the same story, growth in passenger numbers up from 20,000 to almost 26,000. in the half. Lots of innovation. I'll talk later about the private jet touring, which each of those products are worth significant margin contribution to the bottom line. Revenue up from 44 million to 70 million, and we're launching internationally with our operations. Clearly, we already send our guests everywhere in the world, but launching internationally with some of our touring operations to Australia. In money, two major products in the first half, savings and equity release. Savings benefited from the interest rates hikes, but equity release held back. We've gained share in equity release, but the results have been below where we wanted them to be because of the wider market impacts. As I've said, new products launching, I'll cover those later, and very strong net promoter scores. Our customers are really trusting Saga Money with their money. And insurance, 1.6 million policies in force across all of our insurance products, slightly down year on year. The area of concern for us is motor, which has been widely trailed in the marketplace. That's put margins under pressure, slightly below our target of £60 per policy at 56, but we do aim to get back to £60 by the end of the year. Travel revenue and PMI revenue showing strong double-digit growth. So I'm going to pause at that point, hand over to James just to run you through the highlights of the financials, and I'll come back and give you the up-to-date numbers on the core business units after that. James.
Thank you, Ian. So I'll just say a few words on the half-year results and on the outlook for the second half as well. Just turning to the first slide here, revenue's up 15% year on year. That's entirely due to the recovery of cruise and travel, where we are pretty much back to normal, and in some cases ahead of where we were pre-pandemic. In terms of the profit before tax, on the previous basis of reporting, which was IFRS 4 for insurance, we are more or less flat. Under an IFRS 17 basis, profits are down, and the impact of IFRS 17 on the first half was about a £5.4 million negative. This, however, is for a variety of quite technical reasons. It doesn't change our view of the longer-term outlook. It doesn't change our view of the economics of the business. And indeed, there is a pretty good chance that some of the factors that were holding us back in terms of IFRS 17 in the first half will either be neutral or positive in the second half. So I would not read too much into that. In terms of the loss before tax, an improvement year on year, but still obviously a loss. There is a goodwill impairment in the first half numbers, as Ewan mentioned, and that reflects a more challenging outlook for the broking business as we look into next year and beyond. There is, however, one very clear bright spot in these numbers, and that's the operating cash flow in the first half. Almost tripled compared to the first half of last year. That is entirely due to the cruise and travel business, where we went from about cash break even in the first half of last year to a £73 million positive cash inflow in the first half. And that has enabled us to reduce our net debt by 9% in the first half, which is ahead of what the expectations we had at the beginning of the year. Turning to the next slide, this shows a little bit more of the breakdown of the underlying profit before tax. As you can see here, cruise and travel, almost a perfect reversion from an £11.6 million loss in the first half of last year to an £11.8 million profit in the first half of this year. We will see a much stronger result in the second half, and that's due to seasonality. So two bits of seasonality, really. The first one is in relation to the travel business, where about 60% of our revenues are booked in the second half of the year. That's just due to the timing of when customers go on holiday for the most part. And then similarly in cruise, we had a load factor of 83% in the first half of this year, and we would expect a load factor in the second half of somewhere above 87%. Cruise results are extremely sensitive to small changes in load factor. So again, you'll see a much better result from cruise and travel in the second half of this year. That is what gives us confidence that the underlying profit before tax overall will be well ahead of what we reported last year. The challenge in these results is obviously the insurance business. This was something that we flagged back in April when we reported our full year results. It's probably fair to say that the The broking business is under further pressure compared to what we had anticipated, and that is a function of very high levels of inflation, which is squeezing the margin of the broking business. So if I put it simply, the input price here, which is the price charged by panel insurers, is going up faster than the price we can charge to the consumer. That is partly a function of the 3-year fixed product that we have. It's also just partly a fact of a very competitive marketplace as well. And obviously what we're constantly doing there is evaluating the trade-off between margin and volume. Nonetheless, still a very positive contribution to the cash flows of the business. In terms then of other businesses, this went from a £0.4 million profit to a £2.2 million loss. That is mainly due to investment in new businesses. And then in terms of central costs, we are keeping a tight lid on our central expenses, and that's certainly in relation to property costs, and we're also getting a bit more income on our cash deposits as well. So overall, those are the main driving factors behind underlying PBT. Obviously, no presentation would be complete without a view on how we look at net debt. Obviously, this is a very high priority for the company, and there's no change to that. Net debt did fall in the first half of the year by 8%, as I mentioned before, a little bit ahead of expectations. There are a couple of one-off factors within that have helped us, and therefore we expect net debt for the full year to be a touch higher than it was at the half year. But nonetheless, the trajectory here is still for further debt reduction over the next few years. In that respect, we absolutely will repay the May 2024 bonds from available cash, and that is supported partly from the cash that's on the balance sheet, as well as our two facilities. And we have an increased facility with Roger De Haan, which has been increased from 50 million to 85 million, and with the maturity extended to 31 December 2025. And we also have the RCF in place, which is a further £50 million. The anticipation here is that we will probably draw on Roger's loan facility for working capital purposes, and we would then keep the RCF in reserve. So quick word then on what we expect for the full year. So as Ian mentioned, we are expecting double-digit growth, significant double-digit growth in revenue and underlying PBT. And that is the case whether you look at this under IFRS 4 or under IFRS 17. That is backed up by Ocean Cruise, where we think we will exceed the 40 million trading EBITDA target per ship, and with further growth next year, given the very strong bookings profile. And similarly, we expect River Cruise and Travel together to generate at least the level of earnings that we were making before the pandemic, probably higher. SAGA Money will probably be around break even, given that we are investing in new products. Insurance and motor is probably going to be a similar picture in the second half to the first, but we are looking to compensate for those pressures by improving efficiency and reducing central operating expenses by at least £15 million per annum. And last, but definitely not least, we will repay the 150 million bond due in May 2024 from available cash, and that's backed up by the Roger De Haan facility, and then of course the RCF as a further backstop. With that, I'll hand back to you.
Thanks, James. So just to cover a little bit more detail and bring you up to date with where we are with our core businesses and their results. These numbers are largely up to the end of September last week. So Ocean Cruise first. Again, as James has said, and I outlined at the start, ahead of our expectations for this year and for next year. Load factor now at 86%. Strong second half at 87%. Still some opportunity for us to book to move that number forward. Strong per diems in line with first half, and very strong customer feedback in terms of 82 is a very strong net promoter score. We're reconfirming our commitment to now beat the 40 million EBITDA per ship original target for Ocean Cruise, and if you look forward into 24-25, the numbers are even stronger, so trading ahead of where we were to get the numbers in 23-24, with load factors so far booked of just under 50% and £359 per diem. We're already at £359 with a lot of the itineraries that we have in the back end of 23-24. River cruise, again, a very similar position. Really pleased at the improvements in river cruise. It's now matched the service proposition that we have on ocean. Load factor in this year at 85%, so almost mirroring where we got to, or where we've got to so far with cruise. Per diems 285, just so that you understand that difference. That does not include the cost to the guest of getting to the river. So if you add in the cost of either train or air travel to get to the cruise, then you get up to a fairly equivalent number to the ocean cruise value. It's back in profit in the first half. We'll continue to make profit now and grow that profitability through the next 5 years. And looking forward to 2024, again, strong load factor, 30% and 321 per diem, very significant move forward in our monetization of that proposition. Moving on to travel, similar story. So if you look at 23-24 on the left-hand side first, and then 24-25, revenue up 46% on last year and passengers up 27%. That's reflective of higher average selling prices per passenger and a stronger margin base. We've lowered our costs, went digital, and we have more interesting itineraries which are monetizing the brand much better. That growth continues into 24-25 with revenue already at this stage in the year up 15% before the major booking period, and number of passengers up 7 on the numbers that you see on 23-24. Lots of innovation in there. I touched on briefly our private jet touring. It's a very premium product, between £29,000 and £49,000 per person, depending on the itinerary. Each one of those tours worth significant bottom line margin. So even though they may well be small in numbers, they're very big in terms of their impact. Touring continues to grow very significantly, and our customers feeling more confident about traveling worldwide. And we've opened up an operation in Australia that would be a precursor to testing opening up an operation in North America at some point in the next 18 months. And I think it's a consistently growing business. We're back to the levels of profitability pre-pandemic, and we have a key objective to drive double-digit profit growth from travel each year in the next 5 years. Moving on to insurance, still a significant part of our business, under a bit of pressure, as we've said, in motor. The other lines operating well and showing growth. We announced in the last couple of months a new private medical partnership with Bupa, which kicks in January 2024. That opens up digital health and wellbeing opportunities, as well as helping us to grow the core PMI product within Saga Insurance. The team there have identified a number of efficiencies to offset some of the margin pressures that they're seeing in motor, which should deliver between 5 and 10 million per annum as we go through into 2024. And we keep our minds open in terms of when is the right time to dispose of the underwriter. In money, lots of new products coming through. I think I've covered the kind of purple bar on the left-hand side already in terms of our core savings product. But this month we launched fixed rate savings accounts and also legal services, including wills, probates, lasting powers of attorney, which have both started well. In October, we are launching an investment ISA, and in November, we're launching later life mortgages, and there is a good and strong pipeline of new product development set for 2024 and into 2025, all wrapped up in a new website with a new customer newsletter, which will reach over 1 million people. So in conclusion, it's been strong progress across the first half, particularly strong in cruise, travel, money, and in media. We have identified the final chunk of our 2-year program of central cost savings, and also identified some insurance efficiencies to offset the margin pressure that business is under. We will continue to look at the options for insurance underwriting, and we are committed to repaying the £150 million bond in May 2024. And the final point, which is the point I started with, which is that we're on track for significant full-year double-digit growth in both revenue and underlying profit before tax. and we believe and are confident that is ahead of market estimates. So with that, I think we'll pause and go to your questions.
Ewan, James, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Emily, could I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
No problem, thank you. So firstly, we've had a series of questions from Tim L in relation to the facility with Roger De Haan. The first of those is, will the De Haan facility only be drawn down in May 2024? If not, why not?
James, do you want to pick up those ones? We might have lost James. So I think let me.
Hello, sorry, I'm there. I was just on mute.
Okay.
So the Roger facility enables us to draw down on the loan ahead of the repayment of the May 2024 bonds, and that is almost certainly what we will do.
Thanks, James. The next one on the facility is, given that this facility was presented at the time of the full year results as a backstop in case the sale of AICL did not proceed, what has changed since then such that the facility needed increasing by £35 million, especially in light of the release of the £26 million from the travel escrow monies in H1?
I'll take that one as well. So I mean, the first thing obviously is that we had said before that I think in effect, if we were not to sell the underwriting business, then we would draw down on the Roger loan. And I think as we announced yesterday, right now we're not planning to sell the underwriting business ahead of the May 2024 bond repayment, albeit that we may well sell it thereafter, maybe shortly thereafter. In terms of the increase in the facility, this was really just giving us a further level of headroom, and the extension of the facility again just gives us a company significantly more breathing space over the next at least 2 years now, in order to see that the cash generation of the business, including the expense savings and performance of the travel business in particular, start to come through and net debt starts to reduce.
Thanks, James. The next one from Tim on this is, how would this facility be repaid if not from the sale of AICL? In other words, is SAGA leaving itself as a hostage to fortune by delaying the sale?
So I think what we're trying to avoid is exactly that hostage to fortune outcome, in the sense that obviously if we had to, for example, repay the Roger facility in next June or next September or something, then clearly we would need to be in a position where we would be having completed the sale of the underwriting business. So basically this then gives us a much longer time horizon to do that. It also means that you could look at other actions as well. So one of the things that we've evaluated for the underwriting business is, would it make sense to sell it, or would it make sense to effectively run off the liabilities ourselves and release the capital that way? And obviously the longer that we have to do that, the more cash you would get out. And certainly if you look at it over a 2-year view, there's actually not much difference between the cash you would get out from a runoff and the cash you would get from a sale. So the point here, I think, is it just gives the company a bit more flexibility and time to work out the plan for the underwriting business.
Thank you, James. The next question from Tim is, in what circumstances would more than £50 million of the facility need to be drawn?
Well, I think this comes back to the cash position of the company next May, when the bonds are due for repayment. I mean, we can pay them a little quicker than that, so whenever we pay the bonds. In terms of the overall circumstances, I mean, we need to hold a certain amount of liquidity on the balance sheet for working capital purposes. So I mentioned yesterday that typically we would need around £50 million of cash after the repayment of the bonds, just for normal everyday working capital purposes, mainly relating to the travel business. And so it's really a question of how much do we need to draw on Roger's facility in order to meet that £50 million minimum requirement.
Thank you. The next one from Tim is, given that the facility would cost £8.5 million in annual interest costs and £5.1 million in fees if fully drawn, how confident is the board that delaying the sale will create shareholder value?
Yeah, I mean, these are obviously considerations that we've put together, and I think that, I mean, the simple answer here is I think if we were to rush into the sale of the underwriting business, or I mean, rush into it's probably the wrong word, but if we were to execute the sale today, we would definitely have a margin squeeze in the broking business that would be a counterproductive place to be. And the reason for that is because what we've been looking at in conjunction with the sale of the underwriting business is a piece of work to transfer the underwriting that is undertaken by AICL to other people. And given the pressures on motor profitability right now, the only way we would be able to do that today would be by essentially accepting higher net rates from a new partner. And therefore, we think it makes more sense to hold off on that, to look at a wider range of options for the panel. And once you've done that, then you can complete the sale of the underwriting business. And we do have a deal on the table which we would have signed. And we've also spoken to the buyer, who would be willing, we believe, to essentially restart the sale process once there is a solution for the panel in place next year.
Thank you, James. We've had a series of questions from Matthew T. The first is the runoff from AICL likely to fully cover the £85 million loan from Roger?
Well, I mean, I'm not sure if it would get all the way to the 85. It would probably close a significant gap of it over time. But obviously, we are generating cash in the business as well.
Thank you. The next one from Matthew is, you mentioned that central costs are being reduced by £15 million, but city brokers seem to be predicting central costs are likely to rise next year by £5 million. What would be the reason for that?
Well, that's a good question. I mean, we weren't anticipating that costs centrally were going to increase. And I think we can now say that we would expect central costs to be lower. There's also an element of how much of that ends up in the businesses in the form of lower recharges for the services that are provided to them. So whether or not the full £15 million is seen within central costs or whether some of that is in businesses is still something we would work through. But either way, you should see a £15 million reduction in costs.
I think that is more part of the timing. I think you'll see notes coming out in the next week or so, which will more accurately reflect what we updated yesterday, which is the reduction in central costs.
Brilliant, thank you. The next question from Matthew is there any guidance on the timing of the £30 million available for sale properties actually being sold?
So we're very close to the finalisation of that. As you know, the commercial property market has been an incredibly tough place to be over the last 6 months. All of the properties in Kent are closing in on their final exchange and completion. So we should be able to update in the weeks ahead.
Thank you. The next one from Matthew is, in the City presentation yesterday, you mentioned that debt to EBITDA would need to be sub 3 to 3.5 times to refinance the bonds in 2026. Assume this is net of SHIP debt, and what is the current ratio on that basis?
So yeah, I think this would be all of our debt, whether it's SHIP debt or any other debt. On that basis, in the first half, it's 7 times, so there's still a long way to go. But I think that what you see in the first half is certainly not reflective of where we expect earnings to be on a full year basis in the next couple of years.
Thank you. Just a follow up from Matthew T on the central cost point. He said this note RE central cost was from Numis as of yesterday, so it's up to date. Could it be a clarification issue? We can talk to Nick Johnson at Numis and make sure that he understands all of the moving pieces. I think whether
I don't think Nick at this point has necessarily updated his. I mean, he obviously put out a note yesterday. I'm not sure he's updated his numbers though. So I think that would typically come in the next few days.
Thank you. The next one from Matthew is, oil seems to be back on the rise. Are you currently hedging?
Yep. So we're hedged for next year and we're hedged for part of the year after. And that's typically the way we would do it. So we typically start to hedge at the point at which the business goes on sale. So we're obviously on sale for next year. And we would plan to be well hedged for the year after by the time we get to the end of the year.
Thank you. Related to that, Eamon S has a question who asks, how will the increased oil prices affect margins going forward?
Yeah, so as I said, I mean, for next year, so we locked in oil prices for next year some time ago, in fact, when the oil price was at a lower level. So, I mean, that ought to be a positive for profitability in cruise next year. On the basis that we were certainly hedging for next year at a lower level than we're paying for this year. Beyond that, to be honest, it's a bit of a hard question to answer. Typically, obviously, we would, I mean, look to, if there's a need for us to put up prices in cruise to reflect the fact that oil prices are higher, then that is what we would do. And that is indeed what we've been doing in the last few years.
Thank you. Eamon S also had another question, but it was in relation to the property sales. So I believe we covered that. Matthew T asks, when do you expect cruise ship debt repayment to normalise back to original debt amortisation schedules?
So we've got an agreed repayment schedule for the bits of the ship debt that were deferred during COVID, and those payments are being paid off over 4 and 5 years, depending on which year they relate to. So basically, we've got £62 million of debt repayments this year, 62 next year. I think it's 56 the year after that, and fairly soon after that, we get back down to a more normal run rate, which would be around 45.
Thank you. Zonda M asks, thank you for the update on 2024 bonds. Are you able to say anything about the 2026 bonds and how you plan to refinance those?
So it's a bit hard to be too prescriptive on something that's 3 years away. So I think, without being flippant about it, I mean, I think that obviously we're very aware of that refinancing need, but there is quite a long way to go. And clearly the priority at the moment is to get the net debt to EBITDA, including cruise, down to that 3 times level, because at that point, refinancing should not be an especially onerous job. I mean, certainly we would be paying more than the 5.5% we're paying today, but I think at that level, it wouldn't be a particularly difficult exercise for us to do. So that's really where the company's focus is, get the net debt to EBITDA down, and that's a combination, obviously, partly of disposal. So, for example, sale of ACOR, partly also improving the economics of the business, because that not only helps us to reduce debt, it also helps us to reduce the net debt to EBITDA ratio.
Thank you. Zandar also asks, in reference to the 26 bonds, what do you think the level of leverage will be at that point, and how do you anticipate avoiding a bump up in the coupon?
So, I mean, I'd love to say that we would be able to refinance at 5.5%, but I think that's probably a little unlikely. And so we are going to have to pay more. The question is just, obviously how much more. It is 3 years away. It does mean that we've got time to improve the economics of the business and to reduce net debt. And as I say, the goal would be to get net debt to EBITDA down somewhere below 3 times. I mean, ideally, you'd go below that further. So that's obviously the priority. As I say, so we will end up paying more in terms of the coupon, almost certainly, I would imagine. How much more really depends on, obviously, the credit rating of the company and the other factors at the time.
Thank you. There are no further questions.
Ewan, James, thank you. And I think you've addressed all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, Ewan, could I please just ask you for a few closing comments?
Thank you everybody for joining the call. Very pleased to have answered everybody's questions. We look forward to updating you next in January, where we should be able to confirm more details of the progress that we've made on revenue and profitability as we've guided. Thank you very much, and see you then.
Ewan, James, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This may only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of SAGA PLC, we'd like to thank you for attending today's presentation. Good morning to you all.